In this video, let's look at the sources and types of funding that are commonly used to launch early-stage companies. First, you should know that raising capital can sometimes be one of the biggest and most challenging jobs that a founder or CEO of a startup company can undertake. Also, bear in mind that less than 5% of startups that seek outside equity investment are successful in receiving it, and half of those early-stage investments fail and are written off by the companies and their investors. So be sure to anticipate and mitigate failure points in your company and your plans before undertaking a fundraising campaign. So what are some of the types of funding that you can consider? First, and critical to the launch of most startups, are contributions that you may make yourself, gifts from family or friends, or grants and fellowships from universities or governmental agencies. Those are typically non-dilutive. That is, they do not receive any ownership in the company. You can also simply borrow the funds from a bank, for example, in a conventional way that are secured personally or with company assets. Simple agreements for future equity can also be used to quickly raise funds, but sometimes lack detail that can cause problems down the road. Convertible debt is also a means of raising funds, and its biggest advantage is the replacement of a valuation, commonly the most difficult term to negotiate with investors, with a cap that maximizes the valuation that an investor will eventually realize. The actual valuation is realized when the next round of funding is raised and the debt converts to equity. And the investor's preferred type of funding is a priced round, which sets the current valuation and share price of the funds being raised, and funding is directly exchanged for a percentage in ownership. Next, let's look at how funding plays across the developmental stages of a company, from the initial innovation, customer discovery, proof of concept, prototyping and design, customer and product development to manufacturing and delivery. Again, non-dilutional gifts and grants are key to early success and can be supplemented with startup accelerator funding and support from strategic partners like potential customers and suppliers. Angel groups and individual angels will likely be sources in pre-revenue or pre-seed and seed rounds, ranging up to several $100,000. As detailed product design and production leads to real revenue, institutional and venture capital become possibilities, beginning with Series A, which typically is in the $1 million plus range, leading to possible follow-on series rounds. In any case, fundraising can be an exciting and rewarding part of your early-stage company's development, and I wish you all the best in its success.